I'm not here to damn ETFs, but as a vehicle. But we believe right now in buying premium, high coupon, callable, essential service bonds. A lot of that stuff is classic, and what it comes down to is just doing the work, just paying attention.
Given kind of our businesses run around investment management, I guess the question I'll pose out there is that there's been new ETF providers that come every single day. There's new ETFs that hit the market. So what types of products are we missing, or do we have everything that makes our firm run from an investment management standpoint?
I think the type of product I would love to see, forget structure again, product I like to see, and I think that it's demographically, he already mentioned, it's clear. One of the reasons that some of the observer or predictor of the future is that bond yields cannot go very high because the demand for fixed income is only increasing, not decreasing, as the graying of America. There's no question about it. So the product that everybody's looking for, inside retirement for retirement plans or outside retirement plan, is really a predictable stream of income that can compete with annuities. And that's the kind of solutions that I think we are all kind of either from our planning side or as a retiree side looking for, and I think there's going to be a lot of innovation in that space.
The regulatory environment for actively managed funds is actually quite restrictive on what we can and cannot hold. And those should be changed because we've identified that if in an active fund that is on a cash create, cash redeem, there's no discernible difference between a mutual fund, which has those advantages. So we've been working with regulators on trying to change some of that because I think it's hamstringing the ability to bring out really interesting, I think, and holistic, all-encompassing active strategies that can be used like you do in a mutual fund, like the strategic income funds and things like that.
And I agree. I mean, we've seen much more innovation on the equity side of the equation, right? Clients are getting older. We need to create a more solid stream of income.
There are advisors in the room. I don't want to offend anybody, but I don't believe in buy and hold. And there just isn't enough of that active management out there.
You're not going to keep price and NAV together. That's not necessarily a problem with the vehicle. It's the problem with the user that traded the vehicle.
How can we build that fixed income annuity with marketable securities that allows us to show our expertise on bond selection or the right way of where the yield curve is going?
I would say I agree with everything I've heard them say today, but I think it all comes back down to size of client. So the larger the client, the more appropriate your vehicle and the things you've discussed are correct. The smaller the client, we have to have another type of vehicle, and it's going to come down to mutual funds or ETFs.
Yeah, I agree. Absolutely.
And so, because you can't buy individual bonds for somebody in smaller accounts.
They're dependent. So it's our job to get as much yield on a risk-adjusted basis with liquidity and all that.
Are you all looking for more of an outcome-based solution?
I was going to say, you've seen the innovation on the equity side, basically replicating a lot of the active managers' thoughts and philosophies and put them inside ETF vehicles. I think that is yet to be open and available on the fixed income side.
Why hasn't that?
So fixed income,
because it's not a homogeneous market.
So exactly.
So fixed income smart beta that's the next. So we're doing more product proliferation if there's too much product, right? That's probably going to be the next thing that just comes down. You're going to see it everywhere. Schwab Impact, all inside ETFs. Everyone talking about fixed income smart beta.
I think we often forget what is it we're expecting a mutual fund or ETF manager to do compared to or contrasting it to what our responsibilities are. That's not what this is about. So I think it's important that we pick the right managers. That's our job, to prudently select the right managers. But it is also our job to prudently select the right investment policy and the bandwidth within each asset class, by which they are paying us plenty of money, and we can be right and we can be wrong, but we cannot default that responsibility to to the underlying manager who have created a bond fund that's supposed to do X and Y and Z. But it's up to me to add A, B, and C. I want to make it clear that we're talking about two levels of management.
And I agree with the statement. It's not the vehicle, it's what do we want out of it, and then let's choose the right vehicle to go and solve that problem.